Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll begin with Accounting Chapter 8, Unit 3, that is Admission of a New Partner. Let us continue. This is Lecture 1, Chapter 8, Partnership Accounts, Admission of a New Partner. We'll begin with the learning outcomes. After studying this unit, you will be able to understand the reasons for which revaluation of assets and recomputation of liabilities is required in case of admission of a new partner. Also understand the logic of revaluation of assets and recomputation of liabilities at the time of admission of a partner. Learn the accounting treatment under two circumstances. When revalued asset and recomputed liabilities are shown in the balance sheet, and when revalued assets and recomputed liabilities are not shown in the balance sheet. Learn the technique of treating reserve balance on admission of a partner. See the technique of arriving at new profit sharing ratio. Observe the technique of inferring goodwill, although figures of goodwill is not mentioned clearly. Overview of the unit. Revaluation account, profit and loss adjustment account for revaluation of assets and liabilities. Adjustment of goodwill amongst the old partners in their sacrificing ratio. Profit or loss on revaluation account is transferred to old partners in old profit sharing ratio, and reserves lying in the balance sheet transfers to the capital account of old partner in their old profit sharing ratios, because the old reserves belongs to old partners. Introduction. New partners are admitted for the benefit of partnership firm. New partner is admitted either for increasing the partnership capital or for strengthening the management of the firm. When a new partner joins a firm, it is desirable to bring all appreciation or reduction in the value of assets into accounts, so on the date of admission. Similarly, if the books contains any liability which has not been paid, or if the books do not contain a liability which has to be paid, suitable entries should be passed. The purpose of such entries is to make an updated balance sheet on the date of admission. Also, all profits which have accrued but not yet brought into books, and similarly all losses which have accrued but not yet recorded, should now be brought into the books, so that the capital accounts of the old partners reflect the proper figure. As a result of passing of such entries, any subsequent profits or losses will be automatically shared by the incoming partner along with old partners. Also, the value of goodwill is to be assessed, and proper accounting treatment is required to bring the value of goodwill into books of accounts. Treatment for goodwill has already been discussed in Unit 2 of this chapter. Revaluation account for profit and loss adjustment account. Revaluation account or profit and loss adjustment account. When a partner is admitted into the partnership firm, assets are revalued and liabilities are reassessed. A revaluation account or profit and loss adjustment account is prepared, is opened for this purpose. This account is debited with all the reduction in the value of assets and increase in all the liabilities credited with increase in the value of assets and decrease in the value of liabilities. The difference in two sides of the account will show either profit or loss. This is transferred to the capital account of old partners in the old profit sharing ratio. The entries to be passed are as follows. Revaluation account debited to asset account with the reduction in the value of asset. To liabilities account with an increase in the value of liabilities. Next, asset account debit, liabilities account debit to revaluation account. Asset account is debited with an increase in the value of asset, and liabilities account debited with the decrease in the reduction in the amount of liabilities. Revaluation account debit to capitals account of old partner with the profit in the old profit sharing ratio, or in case of losses, capital account debit to revaluation account with the losses in old profit sharing ratio. As a result of the above entries, the capital account balances of the old entry will change. Either it will increase or decrease, and the assets and liabilities will have to be adjusted to their proper values. They will now appear in the balance sheet at the revised figure, at the revalued figure. When the revised values are not to be recognized in the books, sometimes all the partners, including the new partner, may agree to keep the assets and liabilities at the old values even when they agree to revalue them. To record these, a memorandum revaluation account is opened. This account is divided into two parts. A. If the first part, In the first part, the entries for the revaluation of assets and liabilities are made in the usual way as explained earlier. No record for the revaluation of assets and liabilities is made through the respective ledger accounts. The resultant profit or loss on revaluation in the first part of the account is transferred to the capital account of old partners only in the old profit sharing ratio. Next, in order to complete the double entry, entries made in the first part of memorandum revaluation account are revised in the second part so that the values of assets and liabilities remain unchanged. The balance of second part is transferred to the capital account of all the partners, including the new partner, in their new profit sharing ratio. Thus, if there is a point of first part, there will be a loss of the same amount in the second part. The only point to remember over here is that the result of the first part of the memorandum revaluation account is shared by old partners in the old profit sharing ratio, while the result of second part is shared by all the partners including new one in the new profit sharing ratio. Alternatively, the partners may agree that revalued figures will not be shown in the balance sheet and assets and liabilities would appear in the balance sheet at their old values only. In this case, memorandum revaluation account is opened. Any increase in the value of assets or decrease in the value of liabilities is credited to memorandum revaluation account. The journal entry will be asset account debit for increase in the value of individual assets, liabilities account debit for decrease in the value of individual liabilities to memorandum revaluation account. Similarly, any decrease in the value of assets and increase in the value of liabilities will be debited to memorandum revaluation account and credited to assets account in case of increase in the value of asset and credited to liabilities account in case of decrease in the value of liabilities. If the credit side of memorandum revaluation account is more than the debit side, this is a situation of profit. This profit should be transferred to old partners capital account in old profit sharing ratio. The journal entry will be memorandum revaluation account debit to old partners capital account. If the debit side of the memorandum revaluation account is more than the credit side, there is a loss which is transferred to old partners capital account. In the old profit sharing ratio, the journal entry will be old partner's capital account to memorandum revaluation account. So for profits and losses, this could be recorded like this. After completing the above procedure, reverse entries are made for increase in the values of assets or decrease in the value of liabilities, and decrease in the value of assets and increase in the value of liabilities in the later portion of memorandum revaluation account. The profit on revaluation is to be transferred to all partners' capital account in the new profit sharing ratio. The journal entry will be memorandum revaluation account debit to all partners' capital account in new profit sharing ratio. New partners in new profit sharing ratio. The losses on revaluation will be transferred to all partners capital account in the new profit sharing ratio. The journal entry will be all partners capital account debit to memorandum revaluation account. It should be noted that if there is a profit in the first half of the memorandum revaluation account, the later half of the memorandum revaluation account must show a loss. Conversely, if the first half of the memorandum revaluation account shows a loss, the later half of the memorandum revaluation account must show profit. When the memorandum revaluation account is prepared, the book values and assets and liabilities do not change. In effect, the resultant profit or loss on revaluation is adjusted through the partner's capital account. In this way, the amount invested as a capital by the incoming partner may be set at a level that reflects the current fair value of the partnership, even though the book value of assets and liabilities of existing partner remain unchanged in the books of accounts. In case partners desire to disclose assets and liabilities in the balance sheet at old figures without opening revaluation account, then the change, that is either increase or decrease in the value of assets and liabilities, may be adjusted through partners capital account directly. I believe you understood. Let us continue. Difference between revaluation account and memorandum revaluation account. Revaluation account is prepared to find out the profit or loss on revaluation of assets and liabilities which appear in the new balance sheet at the new or revalued figures. Memorandum revaluation account is also prepared to record the effect of revaluation of assets and liabilities, which of course are recorded at their old figures in the new balance sheet. Revaluation account is not divided into two parts, but memorandum revaluation account is divided into two parts. First part for old partners and second part for all the partners, including the new partner. The net result of revaluation of assets and liabilities in the revaluation account is transferred to old partner capital account in the old profit sharing ratio. In the case of memorandum revaluation account, the first part is used to record the change in the value of assets and liabilities due to revaluation, and the second part, the effect of first part, is cancelled. The balance of the first part is transferred to old partners capital account in the old profit sharing ratio, while the balance of second part is transferred to all the partners including the new partner in the new profit sharing ratio. Illustration 1. The following is the balance sheet of Ram and Mohan. The following is the balance sheet of Ram and Mohan, who share profits and losses in the ratio of 3:2 as on 1st January 2014. Assets are given: building, plant and machinery, inventories, trade receivable and bank. Liability side, we have trade payables, Ram's capital and Mohan's capital. On this date, Shyam was admitted on the following. He has to pay 25,000 as his capital and 10,000 as share of goodwill for 1/5 share of profits. The new profit sharing ratio is 5:3:2. The assets are revalued as under: building 25,000, plant and machinery 12,000, inventories 12,000, trade receivables 9,500. It was found that there was a liability of 1,500 for goods received but not recorded in books. Give journal entries to record the above transactions. Also, give the balance sheet of the partnership after Shyam's admission. I believe you understood the question. Solution. Calculation of sacrificing ratio. Sacrificing ratio equals old ratio minus new ratio Ram's old ratio was 3:5 and Mohan's was 2:5, 2/5. So it was 3/5, Mohan 2/5. New ratio 5:3:2, 5/10, 3/10. It is 6/10 minus 5/10 equals 1/10. Sacrifice. Over here it is 4/10 minus 3/10 is 1/10. Sacrifice. We'll pass journal entry. Journal entry. Journal entries. Date, particulars, debit, credit. Shyam has bought 25,000 plus 10,000 for goodwill and capital. January 1, bank account debit to Shyam's capital account. $35,000, 35,000, 25,000 plus 10,000. Shyam's capital account debit 10,000 and sacrificing partners. So to Ram's capital account, to Mohan's capital account. Ratio is 1 by 10, 1 by 10. So 1 is to 1. 1 is to 1, 5,000, 5,000. Revaluation of assets and liabilities. Building 25,000. So there is an increase in the value of building. Plant and machinery, there is a decrease in the value of plant and machinery. Decrease in the value of trade receivables. Revaluation account debit. To plant and machinery. To provision for doubtful debts. To trade payable account. For plant and machinery, 3,000. Provision for doubtful debts 500 and trade payable it is 1,500. Total 5,000 debit. There's a increase in the value of building. So building account debited to revaluation. Seven thousand, 7,000. At last revaluation profit or loss. Revaluation is debit 5,000 and credit 7,000. So revaluation needs to be debited by 2,000. This revaluation profits belong to old partner in old profit sharing ratio. To Ram's capital account. To Mohan capital account. 3 is to 2 old profit sharing ratio. So 2000 multiplied by 3 by 5, 1200, 2 by 5, 800. I believe you understood. Let us quickly draw the balance sheet. Balance sheet of Ram, Mohan and Shyam as at January 1, 2016. Liabilities amount liabilities amount Building is recorded at revalued figure 25,000. Plant and machinery, new figure 12,000. Inventory is at 12,000 and trade receivable at 9,500. 12,000. Inventories at 12,000. Trade receivable 10,000. 500 is provision for doubtful debts. It is 9,500. Bank 5,000 and 35,000 debit, so 40,000. 40,000. Liability side trade payables 16,500. Capital accounts Ram, Mohan and Shyam. Ram's capital was earlier 20,000. Mohan's was 25,000. Ram's capital was 20,000 plus 5,000 25 plus 1,200 26,200. 26,200. Same is for Mohan. 25,000 plus 5,000 30,000 plus 800 30,800. And Shyam's capital is 25,000. Balance sheet totals at 98,500. 98,500. I believe you understood. I believe you understood till here. Let us move ahead. Illustration 2. A and B are partners sharing profits and losses in the ratio of 3:2. Their balance sheet as on 31st March 2016 is given below. Asset side, freehold premises 2 lakhs, plant, furniture, office equipment, inventories, trade receivables and banks. Liability side, we have trade payables. In capital account, we have A and B capital account. On 1st of April 2016, they admit C on the following terms. C will bring 50,000 as capital and 10,000 for goodwill for 1/5 share. Provision for doubtful debts is made on trade receivables at the rate 2%. Inventory to be written down by 10%. Freehold premises is to be revalued at rupee 2,40,000. Plant at rupee 35,000. Furniture rupee 25,000 and office equipment at 27,500. Partners agreed that the values of assets and liabilities remains the same, and as such there should not be any change in their book values as a result of above mentioned adjustment. You are required to make necessary adjustment in the capital accounts of partners and show the balance sheet of the new firm. I believe you understood the question. Solution. memorandum revaluation account, particulars amount, particulars amount. First, we'll do the revaluation of assets and liabilities. Freehold premises revalued at 2,40,000. The previous it was 2 lakh, so 40,000 increase, so it would be credited by freehold premises 40,000. The previous value of furniture is 20,000 and the new value of furniture is 25,000, so there is an increase of 5,000. Office equipment, the new value is 27,500, the old value is 25,000, so 2,500 credit to provision for bad debts, 500 to inventory, 3,000 to plant, 5,000. Part 1 we have completed. 47,500 minus 8,500, 39,000. Profit on revaluation account is to be distributed between the old partners in old profit sharing ratio. A capital account, B capital account. Ratio is 3:2, 23,400, 3 by 5 and 2 by 5, 15,600. This is part 1. In part 2 we need to do reversal of the entries which we have put in over here. First of all, we'll do the reversals of assets. To freehold premises, 40,000. To furniture, 5,000. To office equipment, 2,500. By provision for bad debts, 500. By inventory account, 3,000. By plant account, 5,000 by loss on revaluation. New partners, new ratio. Totaled at 47,500, 47,500, 39,000. New partners, A's capital account, B's capital account, C's capital account in new ratio. So 18,720, 12,480, 7,800. I believe you understood. I believe you understood how we have distributed this in new ratio. Write a working note, calculation of new ratio. Calculation of new ratio. C's share is 1 by 5. So 1 minus 1 by 5, remaining is 4 by 5. This 4 by 5 is shared between A and B. A and B, 4 by 5 in their ratio, that is 3 by 5 and 2 by 5 in their profit sharing ratio. It is 12 by 25, 8 by 25. So new ratio equals new ratio of A, B and C equals 12 by 25, 8 by 25, 1 by 5. Therefore, 12 by 25 is to 8 by 25 is to 5 by 25. I believe you understood. We have used this ratio. 12, 8, 5. 12 is to 8 is to 5. Let us continue. Partners capital account and draw partners capital account. Three partners are there, A, B and C. A, B and C. Particulars A, B and C. Buy balance brought down, opening balance 2 lakhs, 1 lakh. C's capital 60,000. C's share of goodwill is distributed between A and B. C's capital account A 6,000, B 4,000. Profit on revaluation 23,400, 15,600. This capital account will be over here to A's capital account 6,000, To B's capital account, this entry is for goodwill, 4,000. To loss on revaluation account, this is taken from the memorandum account, second part, 18,720, 12,480 and 7,800. At last, to balance carried down. Close it, 60,000, 1,19,600, 2,29,400, 60,000 over here, 1,19,600, 2,29,400. Balancing figure, 2,10,680, 1,07,120 and 42,200. 42,200. Let us make balance sheet now. Balance sheet as at 1st April 2016. Liabilities and assets. Freehold premises, 2 lakhs. Plant, 40,000. Furniture, 20,000. Office equipment, 25,000. Inventories, 30,000. Trade receivable, 25,000. Bank, 70,000. Liability side, trade payables, 50,000 and closing capitals from the capital account A, B and C, 2,10,680, 1,07,120, 42,200. Balance sheet totaled at 4,10,000. Balance sheet totaled at 4,10,000. I believe you understood. Next question. Illustration 3. A and B are partners in a firm, sharing profits and losses in the ratio of 3:2. The balance sheet of A and B as on 1st January 2016 are as follows. Asset side we have building, furniture, inventories, trade receivable less provision, 200, so 34,800. Investment and cash. Liability side, we have trade payables, bank overdraft, A's capital account and B's capital account. The balance sheet totaled at 106,000, 1,06,000. C was admitted to the firm on the above date on the following terms. C is admitted for 1/6 share in the future profits and to introduce a capital of 25,000. The new profit sharing ratio of A, B and C will be 3:2:1 respectively. C is unable to bring in cash for his share of goodwill. They decide to calculate goodwill on the basis of C's share in the profit and the capital contribution made by him of the firm to the firm. Furniture is to be withdrawn. Furniture is to be written down by 870 and inventory is to be depreciated by 5%. A provision is required for trade receivable at 5% for bad debts. Furniture is to be written down by 870. Inventory is depreciated by 5%. A provision is required for trade receivable at 5% for bad debt. A provision would also be made for the outstanding wages for 1560. The value of building having appreciated be brought up to 29,200. The value of investment is increased by 450. It is found that the trade payables included a sum of 1400 which is not to be paid off. Prepare revaluation account and partners capital account. I believe you understood the sum. We need to prepare revaluation account and partners capital account. Solution. Calculation of sacrificing ratio. Sacrificing ratio equals old ratio minus new ratio for A. Old ratio is 3/5. For B, old ratio is 2/5. New ratio for A and B is 3:2:1, 3/6, 2/6. Six threes are 18 by 30 minus 15 by 30 equals 3/30. Sacrifice 12/30 minus 10/30 equals 2/30. Sacrifice C is admitted for 1/6 share, so that is C's gain. C's gain equal to 1 by 6. Because new share is 1 by 6 and there is no old share. Calculation of goodwill. Calculation of goodwill. C's contribution equal to 25,000 for 1 by 6th of capital, share of capital. Therefore, total capital of the firm equals 25,000 multiplied by 6, 1,50,000. Combined actual capital of A, B and C equals 44,000 plus 36,000 plus 25,000 equals 1,05,000. 45,000 hidden goodwill. 45,000 hidden goodwill. Goodwill is shared by A and B in their sacrificing ratio. Therefore, A will get 45,000 multiplied by 3 by 30, 4,500. B will get 45,000 multiplied by 2 by 30, 3,000. And C is a gaining partner, so C will be debited on account of goodwill. Share is 1 by 6. So 45,000 multiplied by 1 by 6 equals 7,500. The journal entry would be C's capital account debit, gaining partner 7,500 to A's capital account, to B's capital account, 4,500 and 3,000. I believe you understood this. Now let us quickly make revaluation account and partners capital account as required by the question. Revaluation account. Revaluation account. particulars amount building is revalued the old value of building was 26,000 and new value of building is 29,200, so there is a positive difference of 3,200. 3,200 trade payables, 1,400 revaluation of investments, 450. There is a positive revaluation of building and investments, and there is a negative revaluation of trade payables. Furniture is revalued downward, 870. Inventory is revalued downward, 1070. Provision for doubtful debts, provision for doubtful debts 1750 minus 200, which is there the question, 1550. Two outstanding wages, two outstanding wages 1560, 5050, 5050. Let us prepare partners capital account now. Partners capital account, A, B and C, particulars A, B, C, particulars A, B and C by balance brought down. Opening balance of capital 44,000 in case of A, 36,000 in case of B. By cash account, new capital brought in by C 25,000. By C capital account, distribution of goodwill 4,500 and 3,000 to A to B, 4,500 and 3,000, 25,000, 39,000, 48,500, 25,000, 39,000, 48,500. To balance carried down, closing figure 48,500, 39,000, 17,500. I believe you understood this partner's capital account. We are stopping here. We are stopping here. Thank you. Thank you.